talk about another special kind of thing, and that's marking to market. If you're a business trader, you can become a mark-to-market trader, which basically means you price things at the end of the year. I've actually qualified for this, and you'd have to qualify for this, and you have to elect Section 475 in the IRS code with your return. You have to file a special election, and then you have to say, hey, I'm a business mark-to-market trader, and what that means is you don't have to deal with the wash sale rule. So that's the cool thing. Basically, I say, what's the account worth at the beginning of the year? Did I add or subtract any money into the account or take any money out of the account? What's it worth at the end of the year? And then when all that is said and done, how much did I make or lose? That's all I pay taxes on, not whether it's a wash sale. So you don't have to worry about deducting losses of trading against other stuff, but you can deduct it against your other limit. You can also deduct any losses from trading against the rest of your income with no limits. So if I lost $200,000 this year, I'd be able to deduct that from my income, and I'd even be able to carry that back possibly and deduct it from my income last year. Now, I'm not going to lose money this year, hopefully, if everything stays the same, but the benefit is no wash sale rule. That's really the critical thing here. You can deduct your losses against other income. One last thing I want to discuss is trading entities. Now, this is important because everyone always asks me, Mark, should I set up a trading company or set up an LLC or an S Corp? My answer is it depends. Now, I believe that if you're going to protect your assets, you should have things in an LLC, so I do. But there are pros and cons to everything. The big pro of setting it up in a corporation is it's really hard for the IRS to challenge it as a business. Remember, you still got to be a pretty active trader, though, and those rules still apply. But it helps to keep everything also organized for tax purposes, and your trading expenses and everything are put into that company. I don't think you should keep it in your name, but it does have some advantages as well. You don't need to maintain a corporation and the fees and the paperwork associated with that in addition to filing a separate tax return. All those are costs. But you also may not have your assets protected by having those assets in your own name. Back to market. Because there's less chance of getting audited with an individual person like me who files a Schedule C, you take some of my gains from market to market, whatever form I file for that, 475, and then it's transferred to my Schedule C to zero out my expenses, and then expenses go on Schedule C. Bottom line is I would probably lean towards setting up your own business, and you're going to avoid a lot of problems. It's just going to be a little bit more costly. Let's go through the form now that the IRS puts out and a couple of opinions, because I want you to have a pretty good mastery of this so that you don't worry about it. Once you get this cleared up, you never have to really worry about it again, but you're going to want to make this decision pretty quickly, and you're going to not want to worry about it. So this is topic 429, traders and securities. I'm just going to read some of it to you. The topic explains if an individual who buys and sells securities qualifies as a trader in securities for tax purposes and how traders must report their income and expenses resulting from the trading business. That's the key word, trading business. This topic also discusses mark-to-market election under Section 475 for a trader in security. In general, under 475C2, the term security includes shares of a stock. Basically, you have to have some evidence in trading in financial instruments. So remember, we talked a little bit about investors. Investors typically buy and sell securities and expect income from dividends, interest, and capital appreciation. They're not trading. So that's all goes down to Schedule D, capital gains and losses, all that kind of stuff. Now we can zip on down to traders. Special rules apply if you're a trader in securities, in the business of buying and selling securities for your own account. The law considers this to be a business, even though a trader doesn't maintain an inventory and doesn't have customers. I would differ from that. I would say stocks and options are your inventory because you're selling them to other people. You're buying them and selling them for other people. To be engaged in a business and trader in securities, you must meet the following conditions. You must seek to profit from daily market movements. Okay, well, that's fair. I mean, isn't that everybody? But isn't that fair? The activity must be substantial. We talked about that. And you must carry on the activity with continuity and regularity. That's the key part of it. Here are some circumstances that should be considered. Typical holding periods, bought and sold. The frequency and dollar amount of your trade. The extent of which you pursue the activity to produce income for a livelihood. And the amount of time that you devote to the activity. So again, if you're just doing this willy-nilly part-time as a hobby, you don't want some IRS agent telling you, no, you can't, it's not going to qualify as actual trading. So you want to do this, make it look as legitimate a business as it really is. You have to show that you're not just doing 1 or 2 trades every month. You got to be in the business of it. You don't want to be considered an investor and not a trader. Let's talk about mark-to-market. Traders can choose the mark-to-market rules. Investors can't. If a trader doesn't make a valid mark-to-market election under Section 475F, then he or she must treat the gains and losses from sales of securities as capital gains and losses and report them on Schedule D as appropriate. When reporting on Schedule D, the limitations on capital losses in the wash sale rules continue to apply. Remember, if you buy and sell something within 30 days, if you buy it back, they allow that loss. And so you want to watch out for that. If a trader makes a timely mark-to-market election, then he or she can treat the gains and losses from sales of securities as ordinary gains and losses, except for securities held for investment. That must be reported on Part 2 of Form 4797. Form 4797, by the way, is the key form that you're going to use to do the reporting. Neither the limitations on capital losses nor the wash sale rules apply to traders using mark-to-market. A trader must make the mark-to-market election by the original due date, not including extensions, of the tax return for the year prior to the year for which the election becomes effective. You can make the election by attaching a statement to your tax return if filed without an extension, or to request for an extension of time to file your return. The statement should include these items. You're making an election under 475F, the first tax year for which the election is effective, and the trade or business for which you're making the election. It's important to try to get the election in as early as possible. Okay, here's another publication. So IRS publication 550 states, to make the market to election, you must file a statement with your timely filed return or with a properly filed request for extension of time to file. The statement must include those things that we just talked about. Mark-to-market election deadline. Unless you are a new taxpayer, the election must be made by the due date, not including extensions, of the tax return for the year prior to the year for which the election becomes effective. So if you've not made a mark-to-market election by April 15th of the current tax year, then you'll typically have to wait until next year to do so. Some exceptions may apply. Please consult with a trader, tax professional about your situation. So it's a critical thing. You have to watch it, and then you'll be reporting those gains on IRS Form 4797. So you may want to seek a quick question with your accountant just to make sure that you're doing it right, but it's really important to get it in as soon as possible if you're going to be doing any active trading, because you don't want to disallow any of your losses against your gains. Thanks for watching. I hope it was helpful. Bottom line here is you've got to be proactive. So go ahead and talk to a CPA, or go ahead and make your 475F election as soon as possible, just to kind of get it out of the way and do it preemptively. And hopefully you'll be able to get it in on time. Listen, subscribe below if you're watching this on YouTube and see all the cool things that we've got going on for traders, for money people, just to learn a lot about different aspects of money. And I hope to see you again very soon. Thanks.